Because of the time constraint, we closed the first part of the video. In the second part, let's see how the fall panned out. So let's start. At this juncture, we should be alert for opportunities to sell short more of such stocks as shown by their individual charts and group charts to be in a weak position. This should be sold short only on bulges, and the fact that the averages have declined from top about 10 points is an indication of a partway rally fall slightly short of the recovery of about half the recent decline. The initial reaction of the downward swing ends on March 4th at around 159, a point at which the market was previously supported on February 14th. Here we have reverse of the situation which existed on January 23rd. The sharp acceleration of the downward movement on March 2nd, 3rd and 4th creates an oversold position. At the same time that the average touches a former support level, a condition that usually is conducive at least to an attempt at a rally due to the buying of traders and others who may believe that stocks are again cheap, and covering of shorts on the part of bear who wish to cinch profit and stand aside, waiting to see how the market will meet a test of the formal supporting level. Our expectations of hesitation and a possible rally from this point are fulfilled as demand from the above source being a fairly vigorous run up on comparatively light volume on the 5th. A further rally to a higher top and a higher bottom next day tends to confirm our anticipation of a possible turning point for more recovery. But the sudden increase of volume on the 6th may indicate the climaxing of the rebound. So we wait for clear indications. Another higher low and a closing near the high on 7th say that the volume of the previous session was climatic on the down rather than on the upside. This demonstration of a change from technical weakness to technical strength brings in sufficient new demand to start the pathway recovery we have been waiting for. However, we do not expect this recovery to carry much above 165 because large interest would not be willing to help the market for enough into the February distribution area to let the public out even. Stated another way, our reasoning is that a part-way recovery would now be a normal development, but the big fellows would be anxious to run the market back to February tops only in the event they saw an opportunity of pushing price far enough above those former highs to realize a profit on the offering they would have to take from the buyers who are hung up with the stocks at these level. Even they should see an opportunity. It is more likely that they would prefer first to tire out or shake out this overhanging supply. However, we reason further that in view of the extent of the distribution as indicated by the heavy volume and breadth of the February campaign, the greater probability is that they will manage just enough recovery to discourage amateur shorts from selling and to keep the February buyers logged in while they at the same time distribute more stocks on rally to a lower top. Meanwhile, we observe that the average from February 24th to March 4th recorded a total decline of 14 points from the high of 173. A normal recovery of less than half of this would be 5 or 6 points in the averages, or to 164 or 165. On March 10th, the average actually recovers 7 points from the low, which is just halfway. Volume on this rally is not measuring up to the standard of the February rise. Behavior which 1 marks the rebound as purely technical, 2 indicates the exhaustion of buying power as a result of filling up all the buyers on the previous distributive movement. 3. Confirming the probable accuracy of our other detections. Around the top of this rally, therefore, we take our additional short positions, selling at the price as close as we can to the danger points on the individual stock charts. so that our risk is limited to a minimum in every case. Further symptoms of progressive weakening of the market's position appear in the dip to March 13th. The volume again remains comparatively high instead of shrinking appreciably, as it did during the corrective reactions of December, January, and the forepart of February. And on the 13th, we find the average down to 158, which is a point lower than the previous supporting point on March 4th. This substantiates the correctness of our general bearish position and suggests further selling on subsequent rallies if we have not sold our full line. In the following several sessions, there is a irregular recovery to 166 with no material nor consistent expansion of volume except for a sudden increase on the 19th. But this has the earmarks of a climaxing indication, confirmed by hesitation or lack of further upward progress on the next 2 days. We now also note that the average is faltering about a point below the top of the rally of the 10th, at the level where our previous deduction led us to anticipate just such a probability. We watch carefully our further developments, realizing that the average has reached a critical position. Should new demand fail to come in here, we may anticipate a decline in proportion with the extent of the primary distribution of February, to which there have now been added secondary distribution on this March rally. Stops on our short position may now be bought down within 1 or 2 points above the highs of March 10th to 25th. There is more lateral movement over the next 3 sessions, featured by a very weak rally on the 24th and 25th. Note the relatively small volume, making a total of 6 sessions during which the average has hesitated just under the lows of February 2028 trading range. The market's inability to overcome the high of March 10th and its failure even to equal that level is now clearly defined, according final confirmation of the comparative safety of our short position. Likewise, a clear warning of advisability of liquidation by investors who may not have sold out heretofore, since we now have all of the elements to corroborate the prospect of a substantial decline. On March 26th, the average starts downward, plunging towards the recent line of 158 to 160. Supports on steadily expanding volume over the next 2 sessions, which tells us in advance that this former lows will not hold. From here on, the downtrend is unmistakable, continuing almost without interruption. A brief rally on the 31st and a small 2 day rebound from the old January 28 February 2nd supporting levels around 152 on April 4th and 6th emphasizes the weakness. Note the immediate shrinkage of volume on these rallies. Next follow several days of holding within a narrow range from April 7th to 14th inclusive. As the average approaches the January 15th to 19th supporting points with no evidence of any selling climax nor convincing rallying power, but as the average levels off and then drifts to a dead center on the 11th, we may reduce the stops on our short positions to a point or so above the levels of a halfway recovery from the April 7th low, merely to guard against an unexpected change of trend. But instead of rallying vigorously away from the dead center, after 6 day apparent support, the market tells us there is still no buying power by its inability to enlist higher support or materially expanding volume when it tries to follow up the advantage of the April 13th bulge. On the 15th, a breaking down into new low ground confirms the above indication and affords an opportunity for increasing our short line by pyramiding with more short sales of the some or other stocks which promise to exhibit the greatest weakness. These sales can be protected by stop orders 1 or 2 points above the high of previous day. And the stops on other shorts may now also be brought down to the same levels. The persistent increase in volume from April 11 to April 18th, accompanied by declining price in characteristic of a liquidating market, and so long as volume continues at about this level or higher, there is little danger on the short side. With systematic stop loss protection as above indicated. There are occasional sharp rallies evident made by short covering, such as on April 30 to May 1st. This kind of buying kept the volume up to around the 3 million share level. As will be seen by the performance of May 1st, such advances are quickly lost because when the numerous shorts have covered, no buying power remains to take place of this demand, and the market underneath proves to be hollow. Observe how the rally beginning May 2nd and running to 4th and 5th is accomplished on markedly decreased volume, showing that whatever demand exists in the expectations of a recovery from the former December supporting level is not willing to follow prices up. Such support is more likely to be due to short covering than the re-entry of substantial buyers. The rally, which begins May 7th, lasts only 3 days until the 9th, and the day's close is around the low, which shows that the bulls have exhausted their buying power. From the 11th, the downward march of price is resumed and the volume again increases on the downside, showing a breaking out of fresh liquidation. Note the complete failure of any tendency toward hesitation or rally as the average touches the critical April lows. Compare this action with December 26 to 30th. A low point is recorded around 113 on June 2nd, with the closing practically at the low. The only warning the average itself gave us of an upturn from this point was the small downward progress made on June 2nd in comparison with the previous day. The closing price on June 1st was 114 and half and on 2nd 113 3 by 8, notwithstanding heavy dealings, 33 lakh shares. This showed resistance, possibly buying by substantial interest. Moreover, the market has now been declining steadily since the high point of February 24th when the average recorded 173. The price of 113 is therefore 60 points down, which means that the price has shrunk about one third from the high. From our figure chart of the averages and the positions of our group chart and of leading stocks in individual charts and the action of our wave chart, we may learn that a danger point to short is approaching. But for the purpose of this explanation of the vertical daily trend chart, we will assume that this is our only guide. So when the market suddenly reverses its form on June 3rd, recovers 9 points from the low in the average and closes nearly at the top with the volume of trading equal with that of two previous days of heavy liquidation, we must somewhere during the session of June 3rd cover our shorts if we are still short. In an event, this should be done at the next day's opening. The averages have shown no preparation for a change in trend. This sudden change is like a hypodermic or a heart stimulant administered to a patient who is dying. He suddenly revives. Having operated on the short side for the past 3 months, we have substantial profits. Even though we cover at the high prices of June 3rd or around the opening of the 4th, we avoid developments in order to ascertain whether this buying factor is sufficient to turn the tide. that is, turn the bear market into a bull market. With sufficient experience as a foundation of our judgment, we know that such violent changes in trend occurring within a few hours are not a lasting basis for bull operations. The closing at the top, June 3rd, in itself indicates a further rally. On the 4th, there is a gain of nearly 5 points over the previous day's high, making about 14th from the low point. The volume is still high, over 30 lakh. That is, we have good progress on high volume. But on the 5th, the gain in the average is only 3 points and the volume decreases a little, showing that the buying power is less. Buyers are reluctant to follow prices after such a steep rise. The closing price is below that of the previous day, which indicates that the day's net pressure or supply of stocks was greater than the demand. This looks as if the rally is over for the moment. On the 6th, there is a further loss of nearly 8 points, bringing the average down halfway from the top. A normal reaction on reduced volume on the 8th. After a further small recession, the average runs up and closes at the top, showing that the market met support at the 120 line. It recovers to 125, which is about two-thirds of the reaction. Although the volume is comparatively light, the speed of the rebound and the behavior just described says the balance is in favor of the bull side. From the 8th to the 15th, a zone is established roughly between 130 and 120. On the basis of what this chart indicates, we are neutral, waiting to see whether when the market walks out of this zone, it will be on the up or downside. As the rallying days proceed, we observe a falling off in the volume, which is not a bullish sign. Also, that on the 11th and 12th, the net gains in the closing price for the day on the upside is a point or less. The average seems to be meeting resistance again where the June 5th rally was checked. On the 13th, the range of average narrows until it is less than 2 points. With a fraction not lost for the day, this is also a bearish sign. The narrowing into dullness at the top of a 17-point rally on a volume of only 5,40,000 shares, about 10 lakh if we double this Saturday turnover. This bearish symptom is confirmed on the 15th by a little wider spread from high to low, meaning more activity, greater willingness to follow price down, a closing near the low, and an increase in volume showing slight increase in pressure. The bearish signs are then borne out by the following four sessions, ending on the 19th, with the volume remaining stationary around 10 lakh. However, volume does not increase on the downside. Instead, it tends to taper off as compared with volume on the rally from June 8 to 12, indicating light pressure. Nor does the price breaks out of the 120 range. In fact, it meets support on the 19th at around 122, which is about 2 points higher than the support on the previous low of the 8th. All now depends upon what the market does in the next day or two. If we have another downward session on increased volume, particularly if the average price goes below the 120 line of previous support, June 8, we must conclude that chances favor a lower market. Compare with behavior of May 14th and 15th. But if support continues around 122 on such small volume, compare with action of Jan 15 to 21st, there may be a trading opportunity on the long side with a close stop. Next day, June 20th, removes all doubts as to immediate tendency of the average. For the market opens up a point and a half above the previous night's close on a greatly increased volume, makes a rapid advance near to 131, putting the average into new high ground above the previous trading zone. The heavy volume emphasized the importance of this. The gain in the average over the previous day's high is more than 7 points and the close is near the top. If we have been watching the tape during the day or refer to our wave charts at the end of the day, we observe this sudden change and we either buy during the sessions of June 20th with a close stop or we wait until the price breaks through its former highs and buy around the closing price of that day or the opening of the following session. June 22nd, as the market's behavior to here tells us, we may expect a quick markup. We are not justified in re-establishing our investment positions. However, we do not have the basis for a lasting advance. June 22nd, there is a higher opening and a gain of 7 points in the average, most of which is held for the day. The volume runs up to 46 lakh shares. The price is gaining in proportion with the rise in volume. A reaction on the 23rd shows that most of the gains of the previous day was lost. But the bullish indication therein is a shrinkage in volume to 26 lakh shares, nearly one half the activity of the day before. That is our warning to sit tight. The 24th recovers the loss. The average advances 8 points from the day and 3.5 points above the June 22nd high or to 141, and the volume is the highest thus far over 50 lakh shares. We begin to grow wary of the bull side because the volume in comparison with the trading of previous weeks indicates selling by large interest. That is probable buying climax. We move our stops up within a point or so of the June 23rd low and await developments. The 25th makes a further gain of 2 points in the average. Then the price slumps about 6 points, closing a point from the low on volume of 43 lakh shares. Large supplies overcoming and excited public demand coming in as usual on the top of the rise. This is distinctly bearish. We therefore close out our long positions and examine our individual charts or stocks are in the weak technical position so that we can get short on the next bulge. June 22nd shows a range of about 5 points, a little narrower. Although the closing is near the top, the volume has fallen off to 31 lakh shares and the uptrust or shortening. In the net, these indications are bearish. The outlines of a new trading zones have been tentatively established between 137 and 143. On the 27th, the average bulges over a point, narrows its range to 3.5 points and closes with a net gain of about 1.5 points on a volume of about 38 lakh. Saturday's volume doubled. This looks like bidding up to a new high in order to catch shorts and selling on the way down. We therefore put out some shorts protecting our commitments with stop 1 3/8 to 2 or 3 points above the high of June 27th. On the 29th, the opening is lower and the price recedes from 144 3/8 the previous day to 140, closing near the low. We now observe that the average has spent 4 days moving sideways, making no further progress after a steep rise from the June 2nd low and following the 5 million share session of June 24th. There has been a steady decrease in volume. In view of our previous deduction, we interpret this to mean that there is a lessening of demand on the top of the rise. We also know that any further lateral movement or reaction would definitely break the upward stride established on the last phase of the advance from June 19th. Hence, we are ready to sell more stocks short if we can get them off bulges. On the 30th, the average declines 3 points to 137 on volume of around 20 lakh, about the same as the previous day. The market is still in 137 to 143 zone, but has now definitely dropped out of a sharp upward angle in which it rose from June 19th to 27th, showing exhaustion of buying power. Low volume on the 2-day dip to bottom of the range 137 to 143, however, suggests we may anticipate an effort to rally back towards the high at 143. The way the market behaves on an expected rally will probably help to confirm or it may contradict our position. So we await developments. The story is still not over. The stocks will fall more or raise more from here. So let's see that in the next video.